Hi, I'm Caleb Merrick, Team Leader of the Finance Team at Momentum Wealth, and I'm joined by Mark Casey, one of our buyer's agents. And we're here to talk about the top tips for people looking to buy an investment property in 2019. Thanks for joining me, Mark.
Thanks, Callum.
Our first tip today, know your budget. So that just doesn't mean knowing how much deposits required just from the bank's point of view. What a lot of homeowners and first-time investors don't factor into the equation is the stamp duty costs, as well as building, pest, electrical inspections, and conveyancing costs as well. And also, just because the bank can tell you can borrow up to a certain amount doesn't necessarily mean you always should. Best thing to do is understand what that proposed monthly repayment will be and try and factor that into your current lifestyle, and you might need to make some adjustments to your current living expenses. From a buyer's perspective, Mark, how can knowing your budget help with the wider investment strategy?
Really good question, Callum. I guess that everyone's different. It depends on the individual circumstance, their income profile, what type of cash buffer they've got. Someone on a higher income can afford to buy a higher land content, which would be typically a higher growth property. It's going to be an older property. But they still need to understand what the associated ongoing costs are to holding that property. Someone on a lower income needs to be careful they get the right type of property. They don't stretch themselves too far. Otherwise, they could be in the position where if there's cyclical movement in the rent, they're forced to sell and can't hold on if interest rates are rising. So it's something we always look at carefully to make sure they're getting the right type of property for their strategy, but also targeting a high growth property that fits their individual circumstances.
Yeah. Our second tip, get a pre-approval. We always advise our investors and home buyers to get a pre-approval in place before they start seriously searching and making offers on properties. And what a pre-approval does is it's the lender essentially letting you know that they're happy to lend to you up to a certain figure. So Mark, do you want to tell us how having a pre-approval in place can help strengthen your position as a buyer?
Absolutely. As a professional buyer's agent, I've worked in different cycles over the last 8 years, and if it's a seller's market and a strong market and difficult from a competitive point of view, if you go in with a solid pre-approved offer, the selling agent's going to look at those offers and it's going to put you in a lot stronger position, particularly where there's multiple offers. When the market's a bit softer, finance terms have been a little bit difficult recently, with APRA tightening and the banks tightening up. It gives you a lot stronger position. We've seen more offers fall over because buyers aren't as organised on their finance position, which gives you greater negotiating strength when you go and place your offer. You can go in harder, and also obviously having that pre-approval in place gives the vendor confidence that your offer will proceed.
Yep. Our third tip is to not let your emotions get in the way. And Mark, I guess you're the expert here with this one. You've probably seen that happen a lot over the years. Do you want to let us know sort of how that can impact a buyer?
Yeah, certainly. This is a very interesting one from an investor psychology point of view. When people buy a home, a lot of it's driven 90% from emotional element and 10% from logic. When you buy an investment, you really want to make sure that's reversed and you've got the logic element and fundamentals in place. From an investor point of view, if they're thinking too emotionally, they'll look at the kitchen, they'll look at how brand new the property is, they'll look at all the features and appliances. They may not necessarily be considering the location, the demographics, the average income, the amount of future supply that can come into the area. If they're buying an investment, they're buying on the outskirts, there's a major risk there's going to be too much supply and they could end up in a negative equity position. We've seen first-time investors buy apartments because they thought it was a new hotspot, apartments going up, and they've gone backwards by 20 to 30% over a few years. So you really want to take that element out and make sure you've got the right key characteristics and fundamentals in place, such as infrastructure, location, amenities, the future growth potential. Obviously, this first investment is going to affect if you can get to 2 or 3 investments in future. So it's very important to remove that emotional element and make the right fundamental decision.
And a good selling agent, I guess, will pick up on that emotion as well and get them to pay a bit more than probably what they should.
Absolutely. Selling agents are very good at it. They're very good at pointing out the right features, and they know psychological logic's driven by emotion. So they'll work on those emotions with the buyer, and that's where having an independent person work on your behalf can ensure that it cuts out the emotional element of the buyer, because the selling agent doesn't see that emotion, and it then becomes a key fundamental decision. What's the property worth? Where is it located? And what are the key drivers for future growth to make sure they're making the right decision?
Our fourth tip is getting the structure of your loans right. It's a factor that a lot of investors often overlook, and a lot of them don't actually realise how important it actually is. Particularly if you're buying your first investment property, a lot of the time you'll already have that principal place of residence, and you don't want to cross-collateralise your portfolio. So effectively what that means is you have one loan secured by two or more properties. It's a big risk for investors because it essentially means that you're allowing the bank to have control over any future decisions you make. If you want to sell or refinance, you have to go to them, and they often have to revalue your entire portfolio to allow you to actually make that step and move forward. Mark, how have you seen in the past, the incorrect loan structures, I guess provide a roadblock or actually hinder an investor's ability to move forward?
It can really limit their ability to build the portfolio. If it's crossed with the one bank, they can't tap into that equity if they've already got a couple of properties. So by having it correctly structured up front, which is difficult because a lot of people don't know about it and don't understand it up front, but getting that right advice will really help you build and accelerate your portfolio over time. So we've seen investors stifled from a perspective that everything's crossed with the one bank and they can't really move forward. Had they structured it correctly up front with different properties in their portfolio and been able to tap into that equity, they could have really utilised that a lot better. We've seen extreme examples where people have come to see us and lost their full portfolios, unfortunately, where they've had everything crossed, the economic circumstances were going well. Worst case scenario, if the businesses turn around and business not going as well and they could potentially lose everything in their portfolio. So it's really a asset protection mechanism to have them set up correctly and structured correctly and separately and not cross-collateralised.
Yep.